Yeah, so for today's Jedi Options, we're going to be taking a look at building a trade on GDX. So I'm going to highlight some of the characteristics of gold and gold miners. I'm going to highlight how I pick a strategy. So strategy selection, the options market's like a buffet. You have lots of choices. So I want to think through logically, intuitively, what would be an appropriate match given my bias on GDX. And I'm going to teach you about that particular strategy. It's going to be a naked put. This is a strategy we've talked about before. But you're going to have a nice, well-rounded understanding of why I'm picking that on GDX here. So let's start with some of the characteristics of this trading vehicle. Traders like diversification because it's a good risk protocol. It's a good risk metric. It's a good risk technique, risk minimizing technique. I don't want to just trade one sector. I don't want to just trade one asset class even. If you have a portfolio full of multiple asset classes and in one asset class, if you have multiple different types of vehicles, it just reduces the odds that you lose on everything. Imagine you had a portfolio right now full of growth stocks. Dude, it doesn't matter what growth company you own. You're getting destroyed. That factor is out of favor. You're sunk. But if you had some commodities, some inflation related plays, what growth is taking away, some of your commodity stuff is giving back. And so it reduces the overall risk of the portfolio. It reduces the overall volatility of the portfolio. So gold and gold mining stocks exhibit different risk reward characteristics, different volatility characteristics than the S&P 500. I don't know if you've paid attention the last couple of days, but gold has had like an inverse correlation with stocks. Yesterday, we had a big rally in the stock market. Gold sold off. The day prior, the stock market was down. The day before that, the stock market was down. Gold was going up. That inverse correlation comes in handy if you own both of the things, because stocks are down, gold is up. Stocks are up, gold is down. It just reduces the overall risk of the portfolio. And I think that makes gold an interesting product, a desirable vehicle to play with if you have a mind towards minimizing risk, expanding your toolbox, your stable of choices. So I think there's a lot of reasons why this is worth having on a watch list and being a product you're willing to trade. The question is, how do you go about trading it? Is it set up now? And we've talked about this earlier in the show, but gold has been firming up. Gold stocks have been firming up. GDX is another way of playing in the gold space. This is gold mining companies. They are more volatile than gold, which could be a bad thing if you're a guy just looking for something that's super stable. But it's a great thing if you are a cash flow trader, someone who sells options. You get more juice, you get a bigger payday when you're selling options in a higher beta vehicle like GDX. And look at the chart. Look at the chart. You have a nice potential bottoming pattern here. You're taking out the 200-day moving average today. You got a nice big green bar. I like the overall look from a technical perspective. Now, this has had failed breakout attempts before. So it's like, I understand that you look good, GDX, but I've been bitten before, and that might influence how I build the trade here. Because I have always two choices when you build an options trade. You can go higher probability. You can build trades where you have a really good chance of success, 70%, 80%, 90%. But you're not going to make a ton of money. Or you can try to make a ton of money. You can build a trade where you can make 50%, 80% return, 200% return. But you're not going to have a super high probability. Probability and payout are on opposite sides of the teeter-totter. And so you have to decide, how do you want to balance that? I love that the options market gives me complete and utter control over how I strike that balance. Do I go for more reward and less probability? Do I go for more probability and less reward? How do I strike the balance? I will tell you, by default, I always favor higher probability, lower reward. And especially when it's a product where I'm like, look, I like you, but I don't love you. I remember the last couple of times I tried to play a gold breakout, I got burned. So I'm erring on the side of higher probability in exchange for, yes, a lower payout, but I still think I can structure it where it's intriguing. Because if GDX goes back down, I don't want to get shaken out. I want to build a trade where I've got good management if it comes back down to 31 or 30, and where I think my trade management skills can work it back to a profit if the breakout fails. All that said, that should tell you that I'm leaning more towards a cash flow type of trade, which ultimately by default cash flow trades are higher probability. So we're talking about covered calls, we're talking about naked puts, we're talking about bull put spreads, things of that nature. This being a $33 stock, I'm looking more towards a covered call or a naked put. And when I'm trying to decide between covered call and naked put, usually based on the strike prices we use, the naked put has a higher probability than the covered call. And so in this sense, I'm going to really err on the side of higher probability, and I'm going with the naked put. I'm going with the naked put. One thing that supports that, on top of what I've already said, is if you look at the implied volatility rank for GDX, it's kind of high. There are times where GDX is hard to build a cash flow trade on because the vol is so low. Fortunately, there's been some excitement, there's been some movement, there's been some recent interest in GDX. And so the bid has been increasing in calls and puts, jacking up the price of those. Okay. So I want to sell a put. I would love to sell a put down around 30, but I can tell you right now, that would have been great yesterday. Because we've already leaped 3% today, it's going to be tough to get enough premium down there at 30. So I'm going to sell a 31 put option. Remember, when you sell a put, you are making a promise to buy the stock. You are obligating yourself to buy shares. I like that idea because I'm a willing buyer of GDX down at 31. If I get paid 50 cents to do it, my cost basis is actually $30.50, which there's a lot of support down in that $30 area. I feel like even if this breakout fails, I can scoop up shares at 30.50, sell covered calls. I think I'm going to work it back to a profit if it doesn't work. Those are the types of trades I have the most confidence on, because if it goes up, obviously I'm happy. If it goes down, I've got a really good plan for how to deal with that. It allows me to approach this with more confidence and not worry as much. Hey, is this breakout going to fail? Should I wait for a pullback? If I wait for a pullback, maybe it'll run up without me. I don't want to deal with all the emotional tug of war between having to guess what's going to happen. I like the setup. I like the trade. I've got a good plan. Now I can move forward with confidence and not worry, right? And not worry. So I'm going to go into the trade tab. The general rules for selling a put, usually we sell 1 month out, maybe 45 days out. GDX right now has got 30 days to the March monthly option, which is just perfect. I like to sell lower deltas. I'd like to sell a delta around 20 or less. Normally, I would default to the 15 delta, but 30 cents is not enough for me in this case. I want a little bit more. And quite honestly, I think the strength of gold and gold miners justifies a little bit higher delta than I usually go for a naked put. So I'm going to stick with selling this March 31 put, 50 cents. 22 delta means I've got almost an 80% chance of success. And bringing in 50 bucks on a $30 stock is actually pretty good. Just the way the math works, I want around a 10% return if I can get it. As long as my cost is less than $500, I should be just fine. So if I take a look at the preview box, you'll see the margin required is 424. Making 50 bucks on 424 is just fine. It meets my 10% return threshold. And just because I'm a nice guy, 50 bucks divided by 424 is 11.8%. Again, beyond my 10% minimum. And so it lines up. The numbers line up. The math works. The chart works. My bias works. The question, of course, is, well, what if the breakout fails? I've got a plan. Again, my cost, if I have to end up buying this, is $30.50. I think that through the sale of covered calls, I could work the basis below 30 within a month or two. And when I look at the long-term chart, I like that zone enough to where I'm willing to take the risk of owning this vehicle around 30 bucks. I think in the long run, I'll be fine. And the thing too, last comment that I'm done is gold and gold stocks are kind of moving to the beat of their own drum. This trade is not contingent on the S&P 500 going back into an uptrend. It is a product that is somewhat unrelated, uncorrelated to what the S&P is doing right now on a day-to-day basis. And that gives me more confidence because I led the halftime report poo-pooing the market and talking about how messy it is. And that makes me even more desirous to look elsewhere and to look at other asset classes like gold and build something there.